Warren Buffett once said that he doesn't really believe in diversification. In other words, if you really know what you're doing, if you're an active investor, then it's okay to put 20 or 30% of your entire net worth in a single asset. In other words, this spray and pray approach, buying 100 different stocks, doesn't really work if you want to outperform, of course. Now, the majority of investors doesn't outperform, and so if you try to outperform and you don't put adequate time into research, then you're very likely going to do worse, because the majority of stocks underperforms, right? It's just a few stocks that have massive outsized returns. The majority of stocks is doing worse than the average. Now, here's something I believe a lot of people do not see. It appears as if Warren Buffett, throughout his entire career, by the way, is putting a lot of his wealth in just a few assets. However, he does diversify. His diversification works through the bond market. So people say that Warren Buffett holds cash, but of course he doesn't hold cash in a bank. He owns government bonds. And government bonds do have some risk as well. They fluctuate in the price as well. They fluctuate with interest rate developments. So when Warren Buffett is holding a lot of cash, what he's actually doing is he thinks that the bond market, at least short term, is going to outperform most of the stock market opportunities. And so I think it's important to make a differentiation here. It's not necessarily important to diversify within one asset class. So to own a lot of different stocks. Now, you can own all the stocks, right? You can just buy an S&P 500 ETF or a NASDAQ 100 ETF if you don't want to beat the market, right? If you don't want to put hours and hours of research every day into the few assets that might outperform, then you can simply just buy the market. But if you want to beat the market, if you want to put in the time and you want to actually pick the individual stocks, you don't have to necessarily own 10 stocks or 20 stocks. You can just own 2 or 3 stocks. It's fine. Most of the diversification benefit does not happen within an asset class. So if you own 10 stocks or if you own 3 stocks, will have very little impact on your overall macro cycle development. In other words, there are times when all of stocks tend to do pretty well and other times when all of stocks are doing not so well. There's a lot of correlation within the stock market. And the same is true for the property market, and the same is true for the precious metals markets, and of course also for the crypto market, right? At one day, Bitcoin goes up, all the altcoins go up as well. On another day, Bitcoin goes down, all the altcoins go down as well. It's the same for the stock market. When Google is going up, then very likely Microsoft is going up as well. And it's the same for the property market, right? If the house in street A is going down in value, then probably the street next door, most of those houses also go down in value. So there's a lot of correlation within an asset class. There's very little correlation across asset classes. And so diversification across asset classes can be useful without actually losing too much expected return. Diversification within an asset class doesn't really help, especially if you're very focused on that asset class. Now, I'm a strong believer in trying to beat one market. So it's very hard actually to beat a market because, again, returns are very much concentrated on just a few assets. If you have just a broad index fund, let's say the NASDAQ 100 ETF, you buy that, you get the average. But there is a high concentration on the top performers because indices like this are very highly weighted on the strong market caps. But if you try to beat a market, right, if you try to do better than the average, then you need to be somewhat able to figure out what are those few winners. And it's not that easy to find that out. The vast majority of people fail at this. And I believe it's simply because they don't put in enough time. And so if you try to beat every single market, there's a good likelihood that you're not among those top investors that can beat the market. So my personal approach is I try to outperform in one of the markets, and this is also where I have most of my exposure. So for me personally, that's the crypto market. And for all the other markets that I'm exposed to, so property, in precious metals, and the stock market, I don't try to beat those markets. I don't try to find the best technology stock. I don't dare to predict whether or not NVIDIA is going to outperform in the next 5 years. I don't have enough knowledge about the demand for AI chips, about how much NVIDIA is really leading against the competition. I don't know enough details about this. I'm not in the industry. And so I can't make a good decision whether or not NVIDIA will be among those few winners. The odds in general are against us, right? Whenever we get idiosyncratic exposure within a market, we have a very high likelihood of doing worse. And so that's why we need to put in all of that time. And so that's why I think it's important to focus on one single market in order to outperform and to try simply just to get the average return in all of those other markets, because we can't be in the top 10%, in the top 5% of all of traders with all of those markets, right? We can't accumulate that much knowledge, right? We have also a life outside of investing.
This video is sponsored by the Premium membership. I never take any money from any crypto project. I never take any affiliate links from centralized exchanges. I never pump and dump coins. Instead, I offer valuable tutorials in the Premium membership. Feel free to check it out.
And there's a secondary effect here, right? Probably outperformances are also skewed more and more towards the very, very high performers. As in, when you're maybe in the top 10% of traders within a market, you can maybe outperform by, say, 1 percentage point per month. If you're maybe in the top 1% of traders, you might be able to outperform by 3 or 4 percentage points per month. So becoming better and better and better in a single market might pay off exponentially. In other words, being among the top 1% in one market might be better than being among the top 10% in 3 or 4 different markets. Trying to be the best in a single market is probably useful. At the same time, it's also useful to have some diversification benefit. And for that, we can simply just go with the average, because getting the average return normally is relatively straightforward. If you want to get the average return in the precious metals market, simply buy gold. If you want to get the average return in the crypto market, simply buy Bitcoin. If you want to get the average return in the property market, simply buy a small flat somewhere in the city center, right? So this is how it works. You simply just buy something that's typical for the market, that's very liquid, and that's very likely going to continue to have demand, say, 10 or 20 years from now. But if you want to outperform, say, the property market, then you go maybe outside of the city center. Then maybe you look at the fixer upper units, right? At the very cheap units that might be underpriced within a street that you can then improve and they can then potentially sell for a higher price. So it takes time to beat a market. It takes experience. It takes skills. It takes dedication. It takes hours and hours. And it's very unlikely that we can be among the top 1% across all of those markets. And so I believe it's good to simply just concentrate, but not concentrate in the way that we only have exposure to one market. You do want to also take advantage of the low correlation across asset classes, that when in case one thing drops, right, in case we do see a stock market crash, that you can then sell your long-term government bonds and buy the bottom. This is basically what Warren Buffett is doing. And so an extension for this would be to, for example, not just hold Bitcoin if you don't believe in fiat currencies, but to also hold gold, for example, because gold and Bitcoin don't have a lot of correlation. They're both very, very liquid. And so if Bitcoin really is going to see that crash that I personally anticipate, if Bitcoin really is going to 40K, maybe even 30K, then we can buy that bottom by selling, for example, the gold. So not all diversification is created equally. Diversification is to a degree an insurance against ignorance, and concentration in certain assets can be the reward for enough research. If you don't put in enough research though, then very likely concentration in single assets is going to create underperformance. Again, because returns are concentrated in just a few specific assets. 75% of all of stocks in the Nasdaq 100 underperformed QQQ, or the Nasdaq 100 ETF, in the last year. The ratio is probably even worse for the altcoins relative to Bitcoin in the last year. It's probably also similar when looking at individual precious metals relative to gold. It's about being smart with diversification. It's about taking opportunity of things that we know very, very well, but still have some money on the side that we can deploy in case the macro of our specific market goes down. Because even though we might be outperforming our specific market by 20 or 30 percentage points per year, the market as a whole might drop by 40 and 50%, and then we didn't make any money whatsoever. That's why we want to have money on the sidelines in other asset classes that we don't want to necessarily beat, but that's very lowly correlated, that can then take advantage of those depressed prices. Because especially if we have our focus on a single market, we can identify when that market is particularly cheap. We know when it makes sense to buy, and we have to be able to take advantage of those crashes. That kind of effect becomes more and more important the more wealth one has relative to income, right? If all of the money that you invest is maybe only 1 or 2 months of your income, you don't really necessarily have to diversify across asset classes, because if we crash, you can simply just save up more, right? You can simply save for another 2-3 months. You're pretty much back to zero, and you can take advantage of the crash relative to your wealth. But if you've already got 2 or 3 years of income saved up, and maybe even more, and then your market that you focus on crashes by 50%, then your active saving won't help much, right? Then you can't really contribute too much towards buying when we crash. That's why the more money one has relative to income, the more having parts of that wealth parked in something that's lowly correlated becomes more and more important. If you found this perspective useful, feel free to give this a like. It helps the channel grow. Feel free to also subscribe. I publish videos regularly. And of course, feel free to also join our Telegram channel. There's a link to our Telegram directly down below this video. Looking very much forward to chatting with you. Cheers!